All right. Good afternoon, everyone. I'm Roger Carter, and I'm the HFMA Director of the North Florida Education. And if you did not join any of the previous sessions today, welcome to the Region 5 HMA Virtual A&A Education event. It is my pleasure to kick off the last session of the day, Tax Update. Before we get started with the presentation, I have a few quick announcements. For those of you who have heard this multiple times already, please bear with me. First, I'd like to take a minute and thank all of the Florida HFMA chapter sponsors. Without them, we would not be able to offer these fantastic virtual education events. I'm sure almost all of you are experts by now, but as a reminder, you need CPE credit. You will need to stay on for the duration of the presentation, as well as answer 3 polling questions to get credit. If you have dialed in via phone, unfortunately, we will not be able to track your attendance, so please log in using the link located in your calendar invite. You will receive a post-event survey generally within 48 business hours that will contain a link to the recording, feedback survey, and certificate. Please feel free to add any questions to the Q&A box during the presentation, and they will be addressed at the end of the presentation if time allows. However, if time expires, we will give your questions to the presenters so they can respond back to you via email. Now, I'd like to introduce you to our presenters, Sally Ham and Tabitha Barton. Both Sally and Tabitha are tax professionals with the Warren Averett Tax Practice. Thank you from the chapter, and please feel free to tell the attendees a little bit about yourselves, and the floor is yours. Thank you.
Okay, my name is Sally Ham. Like Roger just said, we're going to be presenting a tax update. We're going to be talking about the most recent bill that is fully passed and the one that's currently pending for a little while. And then we're going to do a quick update about the ERTC credits and, talk about PPP loans, as, that's been a big factor in COVID relief for, most businesses and facilities and things like that. I'm going to go ahead and move to the next slide. So I have been with Warren Averett for, I believe this will be my 8th busy season. We tax people, we care about tax season, and that's how we count our, timeline. I was recruited right out of college and actually started in audit and then eventually moved into tax as, life happens sometimes, you change our projection. I have worked with, quite a few healthcare clients throughout my time here at Warren Averett. And, we always want to, keep up to date and provide the best information available as timely as we can. And we're glad that Roger and the HFMA asked us to be here. I'll let Tabitha, say a few things about herself. I will, just to give one personal fact, I have a lot of dogs, love them, everybody who doesn't, right?
Hi, everyone. My name is Tabitha Barton. I've been with Warren Averett. This is going into my 4th busy season. I'm a graduate of Troy University and was recruited straight out of college. I did not start in audit. I've been in tax since day one. And I'm so happy to be here and give you guys a little update, basically go over some of the important highlights that have happened over the past year and what we're looking forward to in the coming year. I'll turn it back over to Sally to get started.
Okay, so the first thing we're going to talk about is the Infrastructure Investments and Jobs Act. This was recently passed back in November. It was signed into law, and it's supposed to help fund some improvements to the country's roads, bridges, highways, and the internet connections. Of course, we know that anytime that Congress passes a budget, how are we going to pay for it? It's with taxes. And how are we going to fund it? It's normally with something, something new and different. So some of these things I don't think a lot of these things will directly affect your industry, but everything affects everyone at some point, and there's a trickle down. Some of these things may affect you personally. We're going to, kind of briefly go over what these bills contain and what the tax impact would be if you or your organization is going to be affected either directly or indirectly. Like I said, most of these I believe you will be indirectly affected by. There's, and some of these are what I like to call money generators. So they're trying to, in my opinion, they're making additional reporting requirements to generate some income from, non-filing penalties, or you messed up a little bit and you weren't sure you had a information reporting requirement, some things like that. So we'll move on to what the main items are. Another thing that has really affected everyone with COVID and just natural disasters in general is the wait for the IRS to, say, hey, we're going to extend it again. I know we've been in the never-ending tax season for several years now. We just keep moving the deadline. We're like, we'll just keep moving it back. It's fine. We'll a few more months, So this new bill, the IIJA, there's some automatic extension of deadline provisions, so we won't really have to wait on the IRS to issue those anymore. There's some combat filing extension requirements that they've expanded so that they're being a little bit more lenient for that. They've expanded some other deadlines and filing timelines for, if you're in tax court or anything like that. And then they've also extended due to, significant fires. I don't think anybody in your region, I know it rains every day in Florida. So I know when we're talking about disasters that are affecting you, it's going to be hurricanes most of the time. But, I think some places out on the West Coast have really been affected, and they've really, want to make things, I think, easier for them. So they're not having to issue a bunch of administrative orders and provide a little bit of peace of mind, since they're going to, hit us on some other things that aren't quite as nice.
I do have one question, Sally, on that with the extensions that we're talking about. What are the odds, do you think there's going to be another extension due to COVID? I mean, this is our third busy season now going into it. Do you think there's a chance they'll push back the deadline again?
I very much hope no, but very, very much hope no, that they will not. But I think it just really depends on the cycle and the wave of, infection and how these new strains are affecting people. I know, I'm in a small town. It has not really affected us like it has in some larger places. I know, probably Tampa, New York, there's much higher infection rates just because there's a closer density of people. But I really, really hope not. And I think we see the cycles come in and out, and I don't think it's cycling quite as fast as it had been in the, like the severity of symptoms. We're at a higher vaccine, whatever you think about that. We're at a higher vaccinated population at this point. So it's slowing the spread some, I think. I'm not a medical professional. I do the tax return, the numbers, but
yeah, I would just say from like a client perspective, just don't count on it being extended. So get your information in as quickly as possible.
No, I definitely would not. We don't want any more natural disasters or anything like that. Especially since as we move into these next things, at least one of the major provisions of COVID has been suspended for fourth quarter, which I know you're going to talk about a good bit. So I feel like they're moving away from, hey, we've just got to move on. We can't keep moving deadlines for, at least I hope, please no more deadline extensions. It's, unless we, but it seems like they're trying to make it easier to do. I'll move on to the business provisions now. I mentioned our first bullet point already, the ERTC credit. Tabitha is going to talk about that in a little while. This bill did cut that off a little bit early. We'll talk about that in more detail. Then there's some tax exempt bond financing for broadband projects in underserved areas. I think if you are in a rural area and you're in a rural, you're a rural medical provider, you would see, a lot of your patients just don't have the access to those services. And it seems that this administration wants to push that and is going to be putting some dollars towards that. They're trying to incentivize things, and that, may be a good investment opportunity. I don't know. I know you guys just talked to Melanie before this. So anyway, so there's some other, tax exempt bond things. They've increased the limit for highway and surface freight, bonds. They've provided some, some information and some, I can't think of the word for it now, but anyway, they've provided some, guidance on certain contributions to regulated public utilities, non-taxable, things like that. Some of these miscellaneous provisions have to do with information reporting and digital assets, which I know that is a big thing. Everybody is trading their Bitcoin, and I probably have aged myself like 10 years because I know that's not even cool anymore. Like there's a bunch of other ones, that so everybody's trading those, and the IRS wants to know that you're trading these assets, and they're wanting basically information reporting, just like for cash purposes. Anything over $10,000, there's going to be required reporting out there. Let me look and see if I can remember when this goes into effect. It looks like a lot of this stuff is not going to go into effect until 2023. So you have lots of time to, well, not lots, but you have some time to think about it and think about what you want to do, and how, these providers are going to get this information to you. I know it'll probably end up being similar to your brokerage statements, like your investments. But some of these things are just very unregulated at this point. And, who hates unregulation? The government. They want to, have plenty of things to take it, plenty of reporting. They want their forms. The next miscellaneous provision has to do with pensions. They've extended the interest rate smoothing for single employer plans to 2034, which I believe is a 5-year extension of time from the previous extension. So they're just pushing that on out, give a little bit more time. And then there's some excise tax provisions. And a lot of these, I think, have to do with the administrator's environmental goals. There's some highway trust fund taxes that have been extended. There's some chemical and imported substance excise taxes that have been, modified somewhat. Like I said, I don't think any of these things are going to affect you directly. These are all going to be trickle downs with the transportation of your supplies, your inventory, things like that, things you need to operate. I see the sun's in my face, but anyway, let me move, and we'll move on to our next item, which is the bill that is currently in the Senate. They released some updated legislative text actually this week on the 11th. There's going to be more changes to this bill. We know that they have already cut out a lot of the really scary things that everybody was terrified about, increasing tax rates dramatically. We call that, our 2% really is really a lot when you think about dollars. Modifications to, certain business deductions, trusts, estate taxes. There were all kinds of things that were in this originally that have just been thrown out, and we've got a lot of compromise at this point to try and get this bill passed with some of the items that are important to the administration. Right now, they haven't released an updated revenue table. We'll keep watching it, but they'll probably do it on Christmas or something, or right before, so they can take their time off, like we typically see with them. So I'm going to move on to our next slide, and I'm going to talk very briefly about, some of the things that are in the House bill that was passed. Like I said, these are probably, some of them will stay, some of them will go. There's, a lot of moving pieces at this point, but, we'll scare you now, and then you can, find out later how much they actually followed through with. And a lot of these provisions that are in this BBBA bill are related to international income. So it seems like that's where a lot of the focus is going to be, but there are some that will affect, corporations. They're trying to reintroduce a minimum tax after throwing out the AMT tax with the Tax Cuts and Jobs Act. So we're back to that based off of book income. In the House bill, we'll talk about some Senate modifications as we move down here. They're also wanting to talk about, or they're wanting to add a 1% excise tax on stock repurchased by publicly traded companies. That may affect some of you guys. They're going to delay it because, it's hard to implement things like this, especially widespread, massive changes very quickly when they do stuff in December, and everybody wants to file their tax return on February 15th, right? We want to get our returns done so we can, get our refunds if we have them, our child tax credits, because we're expanding those again. And then, like I said, there's a lot of things that have to do with international provisions. So the global intangible low taxed income, they're wanting that rate to be, I think, 15%. And then foreign derived intangible income, they're wanting that to be at 15.8%. They're doing something, all of these provisions are international, so I doubt they will affect many of your organizations. Then we're talking about surcharges on high income individuals. So if you have an AGI in excess of 10 million, you have a 5% modified, 5% tax basically, and 3% on, in addition to 25 million in modified AGI. We also are seeing, and we have seen this quite a bit, there's a large pushback on the limitation for state and local taxes. I know that Florida does not have an individual income tax, but property taxes are substantial, and being limited on that on your personal return is not always the greatest for anybody, right? We don't want to be taxed on money that we've already been taxed on, pay tax on it many, many times, right? Right now, the current bill has no changes to the tax rates. Our current rates are at 21% for corporate, individual, the ordinary rate, the top bracket is 37% and capital gains at 20%. Right now, the House bill does not have any increases. All of those were dropped from the Ways and Means original proposal. A couple of changes that the Senate has made on December 3rd or 11th. They've retained the corporate minimum tax, but they've added an adjustment for the income expenses and costs related to defined benefit plan pensions, to those contributions and income. I'm sure we're going to see a lot of work on this as it moves forward, but this would only affect corporations as it stands with 3-year average income in excess of $1 billion. So that would be very large organizations, which I'm sure some are on the call and they really want that out. So the other things that have changed, they've got some changes to the energy provisions. They have some changes to the low income housing tax credit, and they've removed the House approved nicotine tax. So we're back for smoking. No taxes on that. Well, no additional taxes. I know it's already got several layers. But as I mentioned at the beginning of this is where it stands right now. Well, on the 11th, it could have changed while we're in this call. They like to keep us guessing. But as it stands right now, there's going to be a lot of changes, we think, and it's already gone through a big negotiation to really kick off a lot of the really scary provisions that a lot of people were unhappy with. Okay, I'm going to move on to, I think, our next slide, which is fun, because we want fun, right? So the Taxpayer Certainty and Disaster Relief Act of 2020, that allowed 100% deduction for business meals in 21 and 22. So, go on that business dinner, have some fun, not too much fun, because, entertainment, no, but, this includes travel meals, and it also includes, they've recently released some guidance that this also applies to the meals portion of per diem that you're paying your employees. And I put that notice out there in case you just want to read it for your pleasure, So fun times, we get to have our meals again, and we're going to move on to the next thing, which is not so fun. I know we all have seen provider relief funds. It's been a major staple of COVID relief for healthcare facilities. And I'll just, read a quick summary. So the CARES Act enacted this on March 27th, 2020, and appropriated $100 billion for Public Health and Social Services Emergency Fund. Then the Paycheck Protection Program and Healthcare Enhancement Act enacted the following month, appropriated an additional $75 billion to the Provider Relief Fund. This funding has been used to date to reimburse eligible healthcare providers for health-related expenses or lost revenues that are attributable to, our COVID-19 pandemic that we're still trying to see the backside of. We're making movements, and we all want to be on the other side of this. I know you guys more than anybody else, because of the additional regulation and, issues that come with, having a pandemic in healthcare. Right now, we are in phase 4 of distributions. These began hitting bank accounts for qualifying facilities in November and December. I believe there was a list released that showed, basically what funding was out there and which facilities may be eligible. And the big question is this taxable? Currently, yes, for-profit industries. If you are a for-profit facility, this is taxable income to you. It's a little, I don't want to speak on not-for-profits, but I believe in certain cases it may or may not be. I would definitely recommend that you speak to your tax advisor on that specific situation. And also, if you're paying for a lobbyist and they are not trying to get this to be non-taxable relief for you, then they are not doing their job, and you need to give them a little poke, try to get them to really push forward and get some additional relief for you. I think we're ready for our first polling question of the day. If we want to pull that up. Okay. So I think it popped down before, there it is. Okay. So it looks like about 50% of our audience has not received fourth round provider relief funds at this point. And 33% says yes, that they have, and 17% say that they are not sure. So that's a good measure of, the size of the facilities that we're working with, because a lot of this fourth phase distributions, they went to small rural facilities. They're in rural areas. Okay, and then I think, going to move on, and I'm going to turn it over to Tabitha, and she is going to talk about the employee retention tax credit with us.
Hi guys, so I just wanted to give a quick kind of overview of the ERTC and PPP, starting with the employer retention tax credit. As we know, this was established by the CARES Act in 2021 and was a refundable payroll tax credit for both wages and health plan expenses paid or incurred by an employer whose operations were either fully or partially suspended due to a COVID-19 related governmental shutdown, or in instances where the employer experienced a significant reduction in gross receipts. This credit was designed to encourage employers to keep their employees on their payroll and continue providing those healthcare benefits throughout the pandemic. This credit is equal to a percentage of wages paid to employees as determined by the size of the entity in question. For 2020, originally, the drop in gross receipts had to have been at least 50% as compared to the same quarter pre-pandemic in 2019. In 2020, a small employer was also considered an entity with 100 or fewer employees, and the maximum wages considered was $10,000. The Consolidated Appropriations Act of 2021, which came out later, extended the ERC eligibility to June 30th of 2021 and increased the rate from 50% to 70% of qualified wages, and also increased the limit on per employee wages from $10,000 for the year to $10,000 per employee per quarter. In addition, employers that received a PPP loan were no longer prohibited from claiming the ERC, even if they had previously filed payroll tax returns without claiming the credit. So if you had PPP back in 2020, you weren't originally eligible, but you could go back and amend those returns to then claim the credit. The 2021 update also reduced the drop in revenue to 20% from prior years versus the original 50%. And the definition of a small employer was increased to 500 or fewer employees. The update also expanded to allow public colleges and universities, as well as certain governmental healthcare providers, which were now able to take advantage of the ERTC. The American Rescue Plan Act of 2021 extended the ERTC for another 6 months to December 31st of 2021, similar to the terms of the Consolidated Appropriations Act. But then came along the Infrastructure Investment and Jobs Act, which Sally talked about, which recently was signed into law. And this quickly and more importantly, retroactively ended the employee retention credit on September 30th of 2021, meaning there would be no ERTC available for the fourth quarter of 2021. Since most 2021 PPP loans were received within the second and third quarters of the year, most employers were really looking forward to taking advantage of the benefit of claiming a higher percentage of wages for the fourth quarter to get that higher ERTC credit. So unfortunately, that's not available now. The most important takeaway here is that employers that have been withholding payroll tax deposits in anticipation of the fourth quarter employer retention credit should work with their payroll service providers and their payroll department to ensure that full payroll tax deposits are made going forward. The IRS has released some guidance regarding how to handle this repayment of the underpaid taxes and other issues that kind of arose due to the retroactive termination of the ERTC. The notice most recently that was put out was the 2021-65. This clarified some of the questions surrounding the retroactive changes. For example, recovery startup businesses will actually remain eligible for the fourth quarter credit. So if your business happens to be one of those that started during this pandemic, you will be able to get that fourth quarter credit. Employers other than those that are recovery startup businesses must repay certain amounts of advance payments that the employee retention credit that was paid to them for the fourth quarter by the due date of their applicable employment tax return. A failure to repay the advance payments by the due date can lead to penalties and fines. This notice also explained that because of the termination of the employee retention credit for wages paid in the fourth quarter, the IRS will no longer waive the failure to deposit penalties for employers that reduce their deposits in anticipation of the ERTC. The notice also states that for deposits due on or before December 20th of 2021, with respect to wages paid on or after October 1st, but before January 1st, these employers will not be subject to penalty under a section noted within the notice. If the employer reduced deposits in anticipation of a credit, if the amount initially retained was reduced, and if their liability is greater than what they have already deposited, they will possibly be facing those penalties and fines. So make sure you are in contact with your payroll provider company and your payroll department to make sure everything is in check and you're making your deposits timely, because we don't want to see you get hit with those penalties and fines for filing late or having underpaid balances. That kind of covers the changes with ERTC and everything we've gone through, basically from 2020 to 2021. Now, if we want to move on to the PPP. So again, just a brief overview of the Paycheck Protection Program. It was established by the CARES Act as well, and created a loan program along with it known as the Small Business Administration, commonly referred to as the SBA. This program enabled businesses and nonprofit organizations with 500 or fewer employees to obtain federally guaranteed loans to be used for payroll, rent, utilities, and other specified costs. These loans were 100% forgivable if employers maintain specific employment and wage levels over an 8-week covered period. There was no interest charged against these loans, and they were not considered taxable income to the business. The program is now starting to wind down since most of the first draw loans have been forgiven at this point, and the second draw loans are also being worked through the forgiveness program basically as we speak, if they haven't already been forgiven.
One thing I want to just throw in there, Tabitha, is the income is non-taxable and the expenses are still deductible. I know that we've been through that over and over again, but I just wanted to make sure that we're aware, that we're throwing that out there again. Also, the timing of forgiveness and when you pick it up on your return and when you're going to have that non-taxable income. There's some notices out there about that and different methods that you can use. Based on a lot of people they received forgiveness in 2021, and we just want to make sure that everybody's out there, aware of the actual implications of it. Because there was a lot of back and forth in the community about timing and how that was going to impact, everyone's, tax liabilities and, what the intent of the government was versus what they originally said. And there's just a lot of, there's been a lot of back and forth. So I would just stress the income is non-taxable. The expenses associated with it are fully deductible for federal income tax purposes. And, you know, that tax exempt income allows you to take the losses from the expenses that you generated using your PPP loan funds. So I'll leave you alone again.
No, you're fine. So going on to the next slide, as of July 30th, 2021, there were over 11 million PPP loans that have been dispersed, totaling $791 billion of cash that have been injected into the economy. Of those 11 million loans given out, over 5 million of those have been forgiven. Those applications have been processed, meaning entities will be reporting close to $470 billion of non-taxable income. As we can see on the next slide, the southeastern corner of the United States really seemed to take advantage of the PPP loans that were available, many of which appear to be given to small and mid-sized entities, which those are the ones that truly needed this influx of cash to stay afloat, basically. Just a few additional notes. Some of the small PPP loans that were under $150,000 are able to be forgiven directly through the SBA versus being required to initiate the full forgiveness process through their original lender, which kind of was able to speed things up, skip a few steps in the process, and get that forgiven more quickly. Also, the loan necessity questionnaire for large loans was removed, which eliminated additional paperwork for some of those entities that were receiving those large loans. I believe it was over $2 million. So that kind of helped out again with the paperwork side. If we've learned nothing from this past year, it's that the government has been very slow to process paperwork. I know on our end, handling returns that are filed via paper take an eternity to get through. So I'm sure it was a help to them as well, not just these entities that received the funds. Again, as a reminder, a PPP loan recipient must maintain their documentation for a period of 6 years after the forgiveness date, which is going to be crucial later on down the road, as we expect audits will increase in the future as the government has time to kind of catch up from all of the changes that we've gone through these past few years. I think we will see, again, another way to raise money is to audit. So as they have more people available, more manpower, more boots on the ground to kind of go through and audit all of this money they've given out basically over the past few years, I would definitely say keep track of your paperwork, keep everything documented as best as you can, because it will definitely help you out later on down the road.
One thing I want to kind of throw in there as well is the interaction between the ERTC and PPP. Even if you filed your forgiveness applications and you included wages for your entire covered period, the IRS has issued some notices and examples stating that if you determined post PPP loan forgiveness application and you reported excess wages, then you could potentially use some of the wages that had been reported for your covered period for the ERTC credit. It's on a case-by-case basis. I would definitely recommend, you get somebody to look at your individual situation. It could be extremely complicated. It could be not as complicated. It's just something to be aware of if you feel like you don't qualify for one because you put, say your covered period ended on, I'm just throwing it on December 15th of 2021 for your first round. And you put wages through December 15th, but you also experienced either some kind of issue with your supply chain, or you had a decline in revenue that would qualify you for the ERTC. If you expended all of your wages well in advance of, you had to, I know in healthcare, there's more healthcare costs, there's more wage costs associated with COVID-19 because you're having to staff more, you're having to provide some incentives to, due to the increased risk in the environment altogether, which a lot of places are. So it's good to really consider all of the steps and all of the things that you could qualify for. And if you question it, then don't just say, no, I don't qualify based off of, you use a third-party payroll provider, you don't file your own 941s. That there's a section in there about that, about how, what to do in that case and how to apply and all of those things. Don't just write it off entirely based off of moving targets, because that's what we've done this whole time. And I think Tabitha really hit home with that, is as we move through all of these processes with the ERTC, with the PPP loans, they have changed dramatically from inception. And there's been a lot of guidance and things that have been issued to clarify and, expand the programs. There was a big rush to issue legislation and to really try and help some people, and it just caused a lot of confusion. And at this point, looking back retroactively, there are a lot of firms and a lot of facilities and clients in general that say, hey, I probably did qualify. It's probably a good idea for me to go ahead and amend my 941 to do this. And we just want to make sure that you're aware that that's out there for you. And it's a moving target. There are a lot of examples. There's a lot of information out there about specific situations that may or may not affect you, that I wouldn't just write it off offhand as I don't have the perfect situation to take advantage of this. Like there's a lot of stuff out there and a lot of ways to qualify. Do you have anything else you want to throw in, Tabitha?
Yeah, just going off of that, I mean, we had so many clients when the ERTC guidance first came out that we really just didn't think anyone was going to be able to take advantage of it because of how the PPP interacted along with it. And to see a 50% drop in gross receipts was, basically killer for clients. So we didn't have many that could take advantage of it until the updated guidance started coming out. And then we started saying, hey, originally we told you no, you couldn't do it, but now we think you can go back and amend. So it was very confusing, not only for the clients. So we feel for you, everything you've gone through. We know it's very confusing on our end as well, just because of everything we're having to keep up with and juggle and stay on top of. So it's not that we are going back and forth being wishy-washy. It's just that the guidance is constantly changing. So it had created a lot of confusion, going back to clients and saying, hey, let's actually take a second and go back and amend those returns. And they're like, well, why didn't you tell us about this in 2020? And it's like, well, back then you didn't qualify, but now you do. So it's a very difficult situation. But I feel like we've made it through. All of these programs are starting to wind down. We're kind of moving on and away from COVID, hopefully. I know the healthcare sector probably does not feel like it's ending as much as it feels like it's ending for us on like the legislation side. So hopefully, we'll just stay on top of it, keep everyone as updated as we possibly can. But hopefully it's coming to an end.
And I'll throw one other thing in there, because this is something that I've recently had to deal with. If you do go back and amend your 941s, be aware you also have to amend your business returns, and if they're pass-through entities, also your personal returns to reflect the reduction in wages that the credit will do. Also, if you're applying for 2021 ERTC credits, And I've just ATM machined, adding some extra words in there. But anyway, if you're applying for the ERTC in 2021, you are very likely not going to receive the money before you have filed your tax returns. The guidance that the IRS has issued currently is pretty clear that you need to accrue those and you need to reduce your wages based on when the wages were paid that generated the credits, whether or not the cash has been received and whether or not you are a tax or accrual basis taxpayer, which is very different from a lot of legislation and a lot of practice that we see. And quite honestly, I think that they're trying to float the bill. Basically, they're using the tax money that you're going to be paying on your decreased expenses, so your increase in taxable income, to pay these credits in the future, because they're about 9 months out, is what I've been told, in processing amended returns and issuing refunds from 2020 and 2021, the first 3 quarters. If you did determine in 4th quarter after your 3rd quarter returns have been filed that you would qualify. So they're in a long game, basically. Okay. And do you have anything else to throw in there? I know I kind of pushed back into the ERTC, but the way it interacts with the PPP loans is just so,
It's pretty fluid.
it is.
I think that's it for ERTC and PPP. I think if we have a polling question,
Yes, I forgot
push
about
out one of those.
Yes. Okay, so it looks like about 43% received a 2nd round loan and 57% did not. So I feel like that's pretty common. I don't think quite as many people qualified for 2nd round, but I will say this, and oftentimes if you qualified for 2nd round PPP loans, you really need to reconsider your ERTC status, because you most likely qualify for some portion of 2021 if you didn't already. So I'm going to move on to our last little section, which is not fun either. Excessive compensation. We all really like to be paid. I know everybody here. The IRS has finally issued the final regulations for the excessive compensation rules. These proposed regulations, the proposed regulations were initially drafted in 2019, and the final ones in 2020. They're going into effect, I believe, this year, if I'm not mistaken, but it was again amended. It was amended by the Tax Cuts and Jobs Act to eliminate the exemption for qualified performance-based compensation. So in the past, bonuses were excluded from this excessive compensation rule. Now there is a transition rule for binding contracts prior to when this guidance was issued, when these regulations came out, and then it extended the scope of who qualified as covered employees. That would also now include the CEO, the CFO, any highly compensated employee would also be subject to this limitation. And that would be $1 million per year in compensation. Again, there are nuance in all of these. It's just something we wanted to throw out there, end on a not as fun note. We probably should have swapped the meals with this one, get to go out and have a nice lunch and let the government let us write it all off. But I think this is our last slide. We've gone through a few things, general update on where our current tax bills are. There's been a lot of them issued. These 2 most recent ones are really seem to be focused more on I would say, international standards. So I don't think it's going to affect a lot of people here. But we all know that the ERTC and PPP loans have really made a major impact on our domestic corporations, companies, small businesses, healthcare, everything involved. And again, I'll just go back to say the provider relief funds have been a huge help, I know, in keeping things moving forward and keeping everybody up in compliance with the additional PPE requirements for COVID. And I know in a lot of cases, it can be a big burden to pay tax on those funds. So if you are paying a lobbying firm and you're not asking them to do that, that's probably, it should at least be on their list of things they're talking about. Because I know that's the major impact of all of this COVID-19 legislation in healthcare are going to be the provider relief funds. So I think I'm going to turn it over to questions if we have time for that, or if everybody's happy to go.
Hey, Sally, we also have one more
Oh,
polling
one more
question.
polling.
Yeah.
Yes, sorry.
It's okay, it's coming.
Okay, so it looks like most of us say no and not sure. About 14% say that we will be majorly affected. I mean, I feel like that can be a good thing. Hopefully, we'll get some clarity on some of these things and it will push forward and we'll all be past COVID and we'll all be in a back in 18 before all this started. Seems like it's been going on forever, right? So are there any questions or are we good to? Because I think we have about maybe 5 minutes.
Betsy, have we gone our mandatory 50 minutes yet? Can you tell?
I do believe we're good.
All right. Well, if there are no additional questions, thank you, Sally, and thank you, Tabitha. Thank you very much. It's certainly been a pleasure going through a nice tax update with you ladies. If anybody would like a copy of any of today's presentation, please reach out to the chapter at www.florida.hfma@gmail.com, and we will certainly try to get that over to you. Before we go, there are a few other things I'd like to mention. Your feedback is important to us as we plan future education events. So please take the session and general feedback survey that you will receive generally within 48 business hours. That would definitely be appreciated. I also want to share with you the value of becoming an HFMA member. HFMA's all-inclusive one-price membership offers the most relevant resources for healthcare finance professionals to meet today's challenges. From unlimited online education to critical regulatory analysis, HFMA delivers the tools and resources you need to simplify and successfully cope with the complex and never-ending challenges that we are experiencing today in healthcare. It's also one of the best ways to meet wonderful, knowledgeable folks like Sally and Tabitha, and you can get more information about that on how to become a member at www.hfma.org. Mark your calendars for future Florida HFMA events, please. You can find more information about that and any upcoming events at the Florida HFMA website. And again, that's www.floridahfma.org, and look under the calendar for events. And thanks again. We look forward to seeing you at the next event.